Imagine being able to predict a dividend cut before it happens. How powerful would that be for your investment strategy? The ability to foresee a dividend cut can significantly impact an investor's returns. It allows you to adjust your portfolio, potentially avoiding a dip in your income. It's about having the foresight to protect your investments, to ensure your strategy remains robust and profitable. So it's clear that knowing when a dividend cut is coming can be a game changer, but how do you actually predict it? Before we dive into the prediction part, it's crucial to understand what dividends are and their role in your investment. At its core, a dividend is a portion of a company's earnings that is paid out to shareholders, typically on a regular basis. These payments can provide a steady stream of income and are particularly attractive to those seeking a lower risk investment strategy. The role of dividends in your investment portfolio is twofold. Firstly, they offer an immediate return on your investment, providing a cushion of sorts against market volatility. Secondly, they can be reinvested to purchase more shares, thus compounding your investment over time. However, when a company cuts its dividend, it can have a significant impact on investors. Not only does it reduce the income you receive, but it can also signal financial trouble within the company, potentially causing the share price to drop. Now that we understand the basics, let's move on to the factors you should watch out for. There are several indicators that could hint at a potential dividend cut. Let's delve into these key factors, shall we? One of the most telling signs is a high payout ratio. This is the proportion of earnings a company pays its shareholders in dividends. A ratio over 80% often signals that a company might be over-distributing profits, leaving little room for reinvestment or to cushion against unforeseen expenses. Another warning signal is falling profits. If a company's earnings are on a downward trajectory, it could spell trouble for dividends. After all, dividends are typically derived from profits. As the saying goes, you can't squeeze water from a stone. You can't expect dividends from a company with dwindling profits. Next on the list is high debt levels. A company with a mountain of debt may need to cut dividends to free up cash and pay off its obligations. It's like trying to pay for a lavish dinner while you're knee-deep in credit card debt. So keep an eye on a company's debt-to-equity ratio. A high ratio could be a harbinger of a dividend cut. Lastly, consider industry downturns. If a company operates in an industry that's going through a rough patch, dividends could be in danger. It's similar to a ship in stormy seas. The captain may need to jettison cargo to keep the ship afloat. In this case, the cargo could be dividends. However, it's crucial to remember that these are just indicators, not certainties. They're akin to storm clouds on the horizon. They don't guarantee it's going to rain, but they certainly suggest you might want to pack an umbrella. In the same vein, high payout ratios, falling profits, high debt levels, and industry downturns don't guarantee a dividend cut. But they do raise red flags, signaling that it might be time to reassess your investment strategy. These indicators alone may not guarantee a dividend cut, but they certainly raise red flags. One of the most effective ways to predict a dividend cut is by analyzing a company's financial statements. This is similar to a doctor reading a patient's medical records to diagnose a condition. The financial statements are the pulse of a company, and by examining them, we can gauge its overall health and its ability to maintain dividends. First up, let's talk about earnings. Earnings are the profit a company makes, and they are a critical factor in determining whether a company can continue to pay dividends. If a company's earnings are decreasing consistently, it might signal that a dividend cut is on the horizon, so keep an eye on the trend of a company's earnings over time. Next, let's move to cash flow. Cash flow is the amount of cash a company generates from its operations. It's like the company's bloodstream, pumping life-giving cash through its veins. If the cash flow is strong and steady, it means the company has enough money to pay its dividends. But if the cash flow is weak or erratic, it could indicate a potential dividend cut. Debt levels are another crucial factor. A company with high levels of debt may struggle to pay dividends, especially if it also has low earnings or cash flow. Think of debt as a heavy weight that the company must carry. The heavier the debt, the harder it is for the company to move forward and keep paying dividends. Finally, we have payout ratios. A payout ratio is the percentage of earnings a company pays out as dividends. If a company's payout ratio is high, say over 80%, it might be stretching its finances to pay dividends. And that can be a warning sign of a dividend cut. So by examining a company's earnings, cash flow, debt levels, and payout ratios, we can get a pretty good idea of its financial health and its ability to maintain dividends. Financial statements can tell us a lot about a company's future dividend prospects, but there's another tool we can use. Stay tuned to find out what it is. In addition to financial statements, understanding industry trends can also help predict a dividend cut. Industry trends can offer a broad view of the potential challenges and opportunities that a company might face. These trends can significantly impact a company's ability to continue paying dividends at the same rate. So, how does an industry trend affect a company's dividend payment? Well, if an industry is on a downward trend, it might indicate that companies within that sector are facing economic challenges. This could be due to a variety of factors, including new regulations, technological advancements that render current products or services obsolete, or a decline in consumer demand. Any of these factors could squeeze profit margins, leading to decreased earnings. When earnings fall, dividends can be the first thing on the chopping block as companies look to conserve cash. On the other hand, if an industry is on an upward trend, it might suggest that companies within that sector have opportunities for growth. This can lead to increased earnings and potentially increased dividends. However, it's important to remember that a growing industry doesn't guarantee a company will increase its dividends. The company might decide to reinvest its earnings back into the business to fuel further growth. Now, you might be wondering, how do I monitor industry trends? It's simpler than you might think. You can start by reading industry-specific news and reports, keeping an eye on economic indicators, and following the performance of industry leaders. This will give you a sense of the overall health of the industry and the potential challenges and opportunities it faces. You can also use financial tools and platforms that provide industry analysis. These platforms often offer insights into industry trends, including changes in consumer behavior, technological advancements, and regulatory shifts. By keeping an eye on industry trends, you can anticipate changes that could affect dividend payments. Remember, the key is to stay informed and proactive. After all, a well-informed investor is a successful investor. So, how do we bring all this together to predict a dividend cut? We've journeyed through the importance of dividends, their roles in the financial world, and the key factors that could signal a looming dividend cut. We've dissected financial statements, delved into industry trends, and now it's time to synthesize this knowledge into a practical, cohesive process. First and foremost, understanding dividends and their role can't be overstated. Dividends are the portion of a company's earnings paid out to shareholders, acting as a beacon of a company's financial health. When dividends shrink or disappear, it's often a sign of trouble brewing beneath the surface. Next, we turn our attention to the key factors that can act as harbingers of a dividend cut. These include a company's payout ratio, its debt levels, and its free cash flow. A high payout ratio could indicate that a company is straining to distribute dividends, while rising debt levels and decreasing free cash flow can signal financial distress. It's essential to keep an eye on these metrics, interpreting them not in isolation but as part of a larger picture. This brings us to the importance of analyzing a company's financial statements. These documents, including the income statement, balance sheet, and cash flow statement, are like a company's financial autobiography. They tell the story of a company's financial health, its successes and failures, its risks and opportunities. By understanding how to read these statements, you can detect early warning signs of a potential dividend cut. But the prediction process doesn't stop at a company's front door. The wider industry trends also play a significant role. Is the industry growing or shrinking? Are there external factors like changes in regulations or market conditions that could impact the company's profitability? These are the questions that need to be asked and answered. In essence, predicting a dividend cut is like piecing together a puzzle. Each piece, whether it's the payout ratio, the debt levels, the financial statements, or the industry trends, is a vital part of the larger picture. And when these pieces come together, they can provide a clear image of a company's financial future. Remember, predicting a dividend cut is part art, part science, but with careful analysis and vigilance, you can make informed decisions and protect your investments.